Hi, everybody. November 14th, the Market Update Desk with Scott Riley, NMLS number 157524. Still kind of working from home. We're week 5 today with the knee replacement surgery rehab. And I had a schedule, but ready to get back at it. It's not as much fun staying at home all the time. So today we had the wholesale version of inflation called PPI, or Producer Price Index. Now that showed that headline PPI came in at up 0.2%, which was higher than October, but it was in line with expectations. Year over year PPI was revised higher in September from 1.8 to 1.9%. And then what that did is increase with today's report up to 2.4% for October. So the upward revision to last month definitely did not help us in the marketplace. And overall, the total year over year being 2.4% is higher than the market expectations of 2.3%. But again, that's from the upwardly revised last month. Now, the core, which strips out the volatile food and energy, rose 0.3 last month, which was in line with estimates. And the actual monthly reading, the non-rounded, was 0.25. So we were 1/100th away from showing 0.2 in the rounded number, which really probably would have helped us out. Now, year over year, core rose from 2.9 to 3.1, which was also expected. Well, actually, I'm sorry, it's 1/10 higher than expected, which was 0.3. A big reason for the year-over-year reading jump was weak numbers from last October, which was removed from that was the replacement number. So once again, we had really good replacement numbers we were getting rid of. We're not replacing them with bad numbers, but just not nearly as good. Now, the Fed's favorite measure of inflation, PCE, personal consumption expenditure, is going to be out later this month, November 27th. And a good amount of data rolls into that from the PPI. So the hot monthly figures could filter through to the PCE and potentially cause an upside surprise. Now, we'll have to wait to see what that's going to be, but it's a little bit concerning as we go forward in the year. We also had jobless claims. So initial jobless claims fell by 4,000 to 217,000. Continuing claims, which measures individuals continuing to receive benefits after their initial claim, fell 11,000 to 11.873 million. Now, things are going to get interesting as we go forward with the continuing claims, because likely we're going to start to see an increase in continuing claims, because as we've seen from the Challenger Jobs Cuts report, also the JOLTS report, hiring is slowing. So when hiring starts to slow, we're going to see those continuing claims start to stretch out longer because it won't be as quick for people to find new jobs. So mortgage bonds, they're still in this big wide range between their 200-day moving average ceiling and the floor at a Fibonacci level of 100.43. The 10-year bond is also trading really in a big wide range of 4.332 and 4.491. As yesterday, we're going to want to be really conscious of the whipsaws, throughout the day that can go back and forth because of this wide range that we're trading in, and because we might not get friendly numbers on the PCE report, and then December 1st we get the jobs report, and Lord only knows what that's going to show. So today, mortgage-backed securities are down 9 basis points as I just look at it. 10-year bond, it's down 1 basis point to 4.43. So we're not seeing a big movement today. We're starting to get some of the calmness after the election. The biggest thing that is going to dictate us going forward is clarity on fiscal policy going forward and how that's going to affect the Fed decisions on rate cuts. It already seems like we're going to see fewer rate cuts and a lower total rate cut number for next year. So the terminal rate's ticked up a little bit, and that's caused the bond market to not be as friendly to mortgage rates. We'll keep on top of everything. Give you an update tomorrow. We got an offer accepted today. Another borrower looking at a house. Give us a call. We'll help you get pre-approved, break down numbers, help you understand why now is probably the most opportune time, probably for the next 6, 7, 8 months to buy a house because of the market conditions. Give us a call, 616-293-2189. The Market Update Desk is your original singular market news source for West Michigan. Have a great afternoon, everybody.